start recording. Okay, so it's really important that you really stay online with the homework submissions, attending the class live. Okay, there will be recorded sessions, of course, but again, if you miss one session, it's really going to start compounding very quickly. All right, so give it your best bet. There's not a lot to do anyway in this environment, so you're limited. So why not make the best of it and invest in yourself? Really come to class and do your best. Okay? All right, so let's do, here I always, for those of you who've had my class before, what I do is I always add like a couple of extra questions that are at the end of the chapter, especially like discussion questions, just to go over, and then we can just, again, this wasn't included in the syllabus, but just for informational purposes, there's some good examples that we could go over. Okay, all right, so let's ask the first question. The first question states, what is the purpose of arranging an income statement to show separated amounts for unusual and or infrequent items? Okay, and remember that's in the continuing education, in the continuing operations section. And then you have after that, if a segment of the business has been disposed of, that segment, the proceeds of that segment have to be disclosed separately, okay, for under discontinued operations. So why do we bother? Okay, why is the income statement revisited, and now we know that it's set up a little differently? Okay, what's the purpose of doing that? Any ideas? Anybody remember? Okay, remember that the reason we do it is because when we separate any discontinued operations, it helps the users of the financial statements in making forecasts. Okay, remember, a discontinued segment is not going to have any effect on future financial statements. This is the last time it's going to appear in any of the financial statements, in the income statements. So basically, it's for forecasting purposes. Okay. Also, again, it's for forecasting what in particular? It's used for forecasting future earnings. Okay, because the future earnings are going to be affected by this discontinued segment. I'm sorry, are not going to be affected by this discontinued segment because it is being disposed of. Okay, so if you are a potential investor, if you are a potential creditor in this corporation that has discontinued operations, which section of the income statement would you be looking at? You would be most interested in the continuing operations section, okay? Because the discontinued operations don't affect either, are not going to affect the continuing operations earnings for this particular financial statement or for future financial statements. Okay, so that's always a question on exams. I'll give you a little heads up. Okay, an investor or creditor is interested in future, for the future investing, and they're interested in the continuing operations figure on the statement of the income statement. Okay. Again, by separating items that don't, and again, to go back to number one, by separating items that don't recur, okay, a decision can be made about normal operations. All right. And again, if you're interested in why this particular corporation is dropping the segment of business, is there a way for you to find out why, what management's plan is? Okay. Is there a section of the finance? Excellent, Christian. Notes. Okay. You would always find when there's a disposal of a segment, you would find information about that in the notes. And that's something you should absolutely look at. Okay, remember the notes are a required part of audited financial statement package. Okay, very good. All right, so let's go. All right, so that was discussion question number one. Let's go to the second one, and this is a great review for this chapter. Okay, explain how each of the following is computed. So I'm just going to move this here. Okay, so the first ratio that we learned about in this chapter is the price earnings ratio. All right, so what is the formula for the price earnings ratio? Again, this is the only ratio that basically takes into account the future the future perspective of the corporation. And the reason is because in the numerator, you have the market price per share. Okay, this is the only ratio that we've ever discussed where the market price per share comes up, and it's market price per share in the numerator, and what is in the denominator, okay, annual earnings per share. Okay, so for these ratios, okay, these are really important ratios. I promise you, you will be using them in your personal life, in your personal investing, in your future financial accounting or business life. Price earnings ratio is basically the market price per share divided by the annual earnings per share. So you have to have the earnings per share before you're able to figure out the price earnings ratio. Okay, remember a price earnings ratio. What's a healthy price earnings ratio? Who remembers? What is a healthy price earnings ratio? Okay. Anywhere, very good. Christian, anywhere from 10, anywhere of a price earnings ratio of 10 to 20. Okay, within that particular scope, that is considered a healthy price earnings ratio. Okay, I think some of you, when you're thinking of the 20, that 20 that you're thinking about is the 20% cutoff for a small stock dividend, which we're going to get to in a little while. Okay, but for the price earnings ratios, please put it in your notes. Anywhere, very good question, from 10 to 20. Okay, a ratio of 10 to 20 is a healthy ratio. Okay. Again, whenever we're talking about ratios, you never just take one ratio and say, okay, I'm going to do my analysis based on this. Okay, you're always going to do a slew of ratios. All right, so here now, let's do the next one, basic earnings per share. All right, so I'm a little limited for space, so I'm going to put B up here, basic earnings per share. When I'm talking about basic earnings per share and I ask on a quiz or an exam, what's the formula for basic earnings per share? Remember, it is always starting with the net income. All right, that's in the numerator. What is in the denominator? Okay, either if the number of common shares has not changed, it's going to be just the number of common shares outstanding. Okay. However, if the number of common shares outstanding has changed over the course of the year, all right, the weighted average number of common shares outstanding is going to be the denominator. Okay, so net income. Okay, and that net income again is the amount that's attributable to the common shares. Remember, the earnings per share ratio only refers to common shares. Okay, you don't do an earnings per share ratio for the preferred stock. Okay, because again, preferred shareholders don't participate in the earnings or excess earnings of the corporation. They're only basically entitled to the amount of their dividend, the stated dividend for that particular stock issue. Okay, all right, that's B. Okay, now let's look at C. Okay, the third ratio, and this is really what this chapter dealt with. These particular ratios, what they mean, what the formula is. Okay, Joshua, you have a question, and it is it possible to do more examples to apply? We're going to have some more as we go through this chapter, yes, as we go over these exercises, yes, we will have them, Joshua. Okay. All right, letter C, diluted earnings per share. Okay, remember, diluted earnings per share is basically going to be calculated for a corporation when diluted earnings per share is going to be calculated for a corporation if and only if, oh, you're welcome, if and only if they have what? Outstanding. What has to be outstanding for a corporation to have diluted earnings per share? Convertible securities. Okay, remember, and those convertible securities are convertible bonds, convertible preferred stock, and stock options that are outstanding. That's the only time you're going to have to calculate diluted earnings per share. Okay, what is the formula for diluted earnings per share? Put over here. It is going to be, again, the net income, which I'm going to abbreviate with just NI. And again, the net income is the amount that is reported on the income statement. It is going to be the net income divided by the maximum number of shares, the maximum number of shares. Again, that's common shares, the maximum number of common shares that could be outstanding. Okay, so basically what happens here when we're calculating diluted earnings per share, we're doing an as-if computation. Okay? Again, we have what the basic earnings per share is, but there are convertible securities. Okay, so we're doing a calculation as to what would happen. Again, it doesn't mean that it had to happen. It means what would happen if any of the holders of convertible securities would exchange those securities for common shares. Okay. All right, everybody good? And we will go over a lot of these computations, Joshua, in the homeworks, I promise. Okay, and if you guys need some more at the end, I'll give you additional ones just to practice. Good? All right, if there are no more questions, we are going to go to brief exercise 12.3. Now follow along. This is a tricky exercise. Okay, now you know the basic formulas, you know the basic format now for the income statement, the revised format. If we have basically unusual and or infrequent items or events that occur over the course of the year, or if there's discontinued operations, we have to adjust the way this information is reported on the income statement. Okay, so here, again, there's a lot of information that's given. So what I would suggest when you have a problem like this for homework on an exam, read carefully and highlight what you need to know. Okay, so here we have Wabash Corporation has revenues and expenses from ongoing business operations of $480,000 and $430,000. All right, so we know right away we can put that here into the regular income statement. This is from regular operations. We can just post those numbers here on the income statement. Okay, and remember, in this particular example, this is for 1 year, and we're going to assume that this is the first year of operations. All right, unless you're told this is an ongoing operation, this is the first year of operations. Okay, now, during the year, the company sold a division of the company that had revenues and expenses, okay, not included in the previous figures, so they've already taken out, okay, the amounts that deal with discontinued operations. They have income from discontinued operations, revenues of $100,000 and expenses of $75,000. Okay. In addition, remember the discontinued operations has to be shown net of the tax effect. Okay, so here the division was sold. The division was sold at a loss of $55,000. We know that that's a bit of information that also has to be reported separately. Okay, so here let's post this to our income statement. So here we have revenues and expenses The difference between these two, again, from normal operations, this is the income from continuing operations. Okay, now we know, since we're seasoned accountants, in real life we would see the income taxes. Okay, the relevant income taxes being subtracted here from continuing operations. In this problem, they just didn't add that particular part. They're really trying to focus on the discontinued operations. Just remember that typically you would total the revenues from continuing operations, subtract the expenses, you would get the net amount, and then from here you would subtract any relevant taxes to get the total income from continuing operations. Okay, now let's go to the next section, discontinued operations. Remember, always reported separately, okay, and that entire division must be sold off. Okay, so here let's look at when we know that when we have discontinued operations, it always must be disclosed net of the tax effect. So here we're told the operating income from discontinued operations. Okay, so the net income from discontinued operations, we know is here. If you look at the bottom, the calculation is there. $100,000 was the revenues year to date. Okay, so here, this operating income, this is the one figure that has to be shown is the operating income year to date, okay, for the discontinued segment. Okay, so we'll take the 100,000, and the nice thing about this, guys, think about it. This information always has to be provided to you. What you have to remember is just what format I'm going to put this information. Okay, I know that for discontinued operations, I have to separate any income or loss year to date. Okay, so that's the $100,000 that's reported here, less the expenses for that division of $75,000. So the net income from discontinued operations from the information given is $25,000. Okay, but I know I basically have to report that net of the tax effect. So I'm going to take that $25,000 in year-to-date income, multiply it by the tax rate, which is given here of 40%. Okay, and that equals $10,000 of net income. Okay, net of the tax effect. So that $15,000, okay, because I'm going to take the $25,000. Okay, which is the revenue. I'm going to subtract out the tax effect for continuing for year to date, which is the $10,000, the 40% tax rate. So the net effect for the year to date operations is going to equal $15,000. Okay, I really didn't have $25,000 from the discontinued operations because 10 of that had to be paid towards my taxes. Okay, I had higher income. Okay, then I'm going to look at the second piece. Remember, these two pieces of information must always be provided in the discontinued operations. So here, the second piece is any gain or loss on the disposal of the assets of that division. Okay, so here, what am I told? I'm told that the division was sold at a loss. That means the assets of that division were sold at a loss of $55,000. Okay, but I know that $50,000 is basically the gross amount. All right, so I will take that $55,000 loss. Okay, I am going to multiply it by 40%. Okay, and that 40% equals $22,000. Net of $22,000 in income tax. Okay, so what is the net amount of the loss? Remember, when a corporation has a loss, okay, when a corporation has a loss, all right, that means that the tax effect, okay, there is a tax benefit when there's a loss, okay, because you can, just like if your expenses are higher what happens to your net income? Your net income is lower. When your net income is lower, that means the amount of taxes that you're going to pay are lower as well. Okay, so since the corporation had a loss on the disposal of the assets of that segment of $55,000, the net value of that loss is not really going to be $55,000. There was a tax benefit, okay, because the net income was decreased, we had a tax benefit, okay, of $22,000, which is $55,000 times 40%. Okay, so what was the net loss really on the disposal of the segment of those assets? $33,000. Okay, so what was the result of selling off that particular segment? The net effect was was a net loss of $18,000. Okay, so that $18,000 loss, okay, and that's a net loss on the disposal of the segment. We're going to subtract that from discontinued operations. Okay, so what is the net income for Wabash Corporation for this particular year? $32,000. Okay, question. Okay, and this is the key, one of those pivotal points. Okay, we're going to bring home the whole study of this revised income statement. If you were a potential creditor or an investor of this corporation, which of the income figures would you be most interested in? Would you be interested in this $50,000 net income from continuing operations? Or would you be interested in the $32,000 net income from the total operations of this business for this particular year? Very good. You would be interested, excellent guys, in the continuing operations, because this is the number we're going to be using in our forecast. Very good. We're going to be using Shamia, Denise, Josh, very good, Kristen. We're going to be using Daniels. We're going to be using the continuing operations. Okay, because it's
I have a question. Sorry.
Sure. Yeah.
How come on a loss you get a tax benefit again?
Okay, so what happens is we had a loss of $55,000. Okay, so Shamia, again, a loss is basically, let's say it's an addition. Let's treat it like an expense, because that's where it's going to basically appear on the income statement as a negative cash flow, right? Okay, so if we had a loss of $55,000, okay, all right, again, what does a loss do to the net income of a corporation?
Decrease it?
Yes, it decreases it, okay? But since we are paying income taxes at the end, okay, the net tax effect, since that $55,000 loss decreases the amount of net income, it's also going to decrease the amount of taxes we have to pay. Okay, since that's a cash outflow, it reduces the amount of taxes that the corporation has to pay as well. Does that make sense?
That does, thank you.
Okay, sure. So then what happens, since we're really, and it's considered a tax benefit, since we really didn't have a loss of $55,000, it was reduced or offset by the amount of the tax savings we got from that particular loss. So the net effect of that loss is going to be only $33,000, and that's what we're really going to report here. Okay.
All right, thank you.
Good. Okay. Oh, you're welcome. Good question. Okay, everybody's good with that? Okay, great. So we have finished that particular exercise. Please remember, everyone, that these exercises are great, and your homework problems are a great way to review for exams. Okay, because this really gives you the calculations. I know there's a lot of information that we're going to go over, but these examples really help you understand how you apply them. Okay. And our exams will have theory questions as well as calculation questions. Okay. All right, and again, this is just the calculation for the earlier problem, the $55,000 loss times the 40%, the income tax savings really in this instance, because this is a negative amount. The net amount of that tax loss equals $33,000. No, Joshua, I haven't really considered what the date of the first exam is going to be, but after we complete chapter 10, which is the next chapter, we're going to have a quiz on that chapter first. Okay, and then we're going to have, we're probably going to have the exam after the third chapter, which I think chapter 7 is the chapter after that. Okay, so we'll have the midterm, yes, after chapter 7. Okay, but we'll have a quiz on chapter 10 first. All right, and I know if there's holidays for anybody, when I mention that, you know, I'm having exams or quizzes on a certain day, please let me know if there's something that's a general type of thing that you're not going to be able to take an exam, because I can always switch it then for everyone. Okay. And now, Rajiv, in the journal entries under discontinuing operations, what would you write? Net income and operating income from continuing operations. All right, so what you would do, all right, great question. And in life, okay, I always tell my students, whenever you're in doubt, go back to the journal entry, because a lot of times that will help you understand what the result is. Okay, so when the corporation decides that it's going to sell a segment of their operations, okay, the first piece that has to be reported is the income from the discontinued operations. Okay, so here, what they would have posted in their general ledger, okay, at the time of the sale. All right, what they're going to do is they're going to show, so what does it say here? During the year, this company sold a division that had revenue and expenses. Okay, so that means the expenses, okay, that are related to that operation would be debited. Okay, oops, spell that right, EX. Operation. All right. Theoretically, the journal entry would be $100,000 for the expenses for that particular division. Okay. Then what would the credit be? The credit would be to revenues, discontinued operations. Okay, so then, and that would be for the $75,000. Okay, so that means the net effect, okay, on our operations would be the $25,000, which is the amount of operating income or year-to-date income from the discontinued operations. Okay, it would be this way. Okay, then you would see, okay, and now remember, it's not that I'm just doing like a summary journal entry here. Remember, if at the beginning of the year I hadn't disposed of the segment yet, I would just be recording expenses from that division and revenues that from that division on an ongoing basis. Okay, they would just be included as regular expenses and revenues. Okay, I'm just doing it here as like in a summary format. Okay, so these are just the summary. These expenses would have been debited over the course of the year, and then I'm just reporting them separately here. Rajiv, does that make sense? Okay, and then what would I have done? Since I have to show it net of the tax effect, I would just, I would just have debited income tax expense. And again, this would most likely be at the end of the year. I would just debit and here for the income tax expenses, they didn't indicate what the amount of the taxes were from the continuing operations. Really, that's a flaw with this particular problem. They really should have told you the amount of the taxes for that division. Okay, so here it would be income taxes debited and income taxes payable. For that particular division. Okay. And then the journal entries for discontinuing operations, again, you would have had a similar thing. You would have had expenses being debited. Here, you would have to, what you're going to be doing when this particular division is being sold off, you would have to look at your financial records, okay, to determine the revenues and the expenses that have been generated for these two pieces of information. Okay, you would have to look at what the operating income was from the discontinued operations. Okay, and then basically you would determine from your journal entries, from your general ledger, you would have to research and see that the amount of net income from discontinued operations equals $25,000. And the amount, and then you would do the calculation and do a journal entry for the discontinued operations the same way. Okay, so it's like in the normal course of events, a corporation at the beginning of the year is not really, they don't know necessarily when and if they're going to be disposing of a segment of the business. They're just going to be doing their journal entries on a continuing basis. Okay, it's only then when they decide to dispose of the segment that they're going to have to isolate the revenues and the expenses from that disposed of division and then determine these figures. Okay, that's why whenever you have a problem like this, you're always going to have to be given this information, what the revenues, the year-to-date revenues and losses were from that division. Okay, because they're not going to give you the whole general ledger, and then you would determine what the division, or whether it was a gain or a loss when they sold the assets of that division. Okay, Rajiv, does that clear it up a little bit for you? But very good question. Okay, so whenever you're in doubt with any of this, remember, go back to the journal entry. Good, it really helps you. Okay. All right, so let's go over the next brief exercise. Okay, so this one is pretty straightforward. Here, so this is the statement of retained earnings. Okay, now remember, the statement of retained earnings is not a required financial statement, but a lot of corporations choose to prepare the statement so that because it really it's a good supplemental statement that ties into the results here on the statement of retained earnings is going to tie into the income statement. Okay, so here you get, these problems are great because you're given a lot of the information. All right, so here, Messer Company had retained earnings at the beginning of the year. Remember, you always have to start with that on the statement of retained earnings. They had, they reported $590,000 for retained earnings. Where did the beginning retained earnings come from? From the balance sheet of last year's retained earnings. Okay. Then here we know that net income of $88,000 was earned this year. The net income for this year is always, or net loss for this year is always added to the retained earnings at the beginning of the year. So this equals our subtotal. Okay, and that's basic. You remember, you all remember that from Accounting 101. Okay, now is when it gets tricky. Okay, here we're told that a cash dividend of $1.20 per share was declared and distributed on the $50,000 50,000 shares of common stock outstanding. Okay, now what you have to remember that, okay, here I'm told it's a cash dividend. Always remember, regardless of what type of dividend it is, whether it's a cash dividend or whether it's a stock dividend, okay, whether it's a dividend on retained earnings or it's a dividend, I'm sorry, whether it's a dividend on preferred stock or if it's a dividend on the common stock, all dividends reduce the amount of retained earnings. Okay, so here we're going to calculate, we're told, all right, we're told all this information. We just have to figure out how do we calculate the retained earnings. So here, the corporation, the board of directors declared $1.20 dividend per share on each of the 50,000 shares of common stock outstanding. Okay, so that means the total amount of the cash dividend was $60,000. Any type of dividend always reduces the amount of retained earnings. So what is the retained earnings figure? Okay, what is the retained earnings balance at the end of this year? It's going to equal $618,000. That's the amount that's going to be posted to the balance sheet at the end of this year. Okay, so that's one of those basic financial statements, the retained earnings. That's what a basic retained earnings statement would look like. And do it this way. Start with the opening balance, add the net income, and then anything else that changes, always have it afterwards. Okay, just follow that format and you won't run into any problems. Okay, quick, easy problem. Definitely going to see that on the midterm. Okay, and again, it's going to be in the format of a multiple choice question. Okay, everybody good? Okay, so let's go to the next exercise, which is a little bit more complicated. Okay, so everybody hold on. All right, you ready? All right, so Alexander Incorporated declared and distributed a 10% stock dividend. Okay, remember, all dividends come out of retained earnings. Okay, what is a stock dividend? A stock dividend basically means cash is not going to exchange hands. Okay, but the corporation is going to award a pro rata distribution of shares. Okay, so Daniel Zhang. Okay, I'm going to pick on you because I don't see your face. Okay, so today I'm going to pick on some of the who don't have profile pictures. So Daniel Zhang, are you there? Okay, very good. All right, so immediately, if you're walking down the street and someone comes up to you and says, okay, what is the first question that comes to mind when you know that there is going to be a stock dividend? Okay, what is the first thing that you're going to blurt out to this person who asks you what's relevant about a stock dividend? I don't mean to put you on the spot, Daniel. That's okay. Excellent. Joshua, good. Very good. Is it a small stock dividend or is it a large stock dividend? Okay, that is always the first question that is going to come to mind. Not for a cash dividend. Remember, for a stock dividend. Is it a small dividend or is it a large dividend? Okay, very good. And basically, the cutoff is going to be 20%. Oops. Okay, a small stock dividend is less than 20%. A large stock dividend is going to be greater, 20% and above. Okay, so now we see that this is going to be a small stock dividend because it's only 10%. Okay, what you're also going to remember is that if it is a small stock dividend, which is the amount that is going to be capitalized? Okay, if it's a small stock dividend, the amount that's going to be capitalized out of retained earnings, excellent, Denise, is the market value. Excellent. That's the first thing if you remember that information, stock dividends are never going to be a problem for you. Excellent. Okay, so here it's a small stock dividend, so we are going to have to capitalize the market value of those shares. Okay, so, oops. All right, so here, now here, this problem's a little tricky. Okay, so for those of you who are going to sit for the CPA exam, this is the type of tricky question that they may ask, or on my exam too. Just remember, highlight what is relevant. Okay, so here, the corporation had 700,000 shares of common stock. Okay, only common stock can have a stock dividend. So they had 700,000 shares of common stock that has a par value, that has a par value of $5 per share. Okay, then, and again, just assume this all happens in the first year of operations. Okay, this problem is a little tricky. Assume this happens all in the first year of operations. Okay, so here the par is $5. Okay, we know that. And at the time the stock was originally sold, the market price per share was $12. Okay, so this is really a tricky problem. So when the initial sale, okay, the par value was 12. When they sold those 700,000 shares, the market price was $12 per share, and the par value was 5. So that means when they sold the initial 700,000 shares, the excess, okay, of the market value over par was $7 per share. Okay, and that'll come back in a moment. All right, they sold the original 700,000 shares for $12. The par value was 5, so $7 is the amount that will get credited to the additional paid-in capital account. Okay, now what else are we told? Okay, this is a complicated problem. The balance in the retained, the balance. Oh, sorry, the outstanding shares originally had been sold at, oh, I'm sorry, I said that wrong. So here, all right, so Alexander had distributed a 10% stock dividend on the 700,000 shares of par value stock. When the stock was originally, oh yeah, so for the original sale, I'm sorry, it was the $7 additional paid in capital. The outstanding shares had been sold at $8 per share. Wait a minute. Alexander 700,000 shares of outstanding $5. When, oh, sorry. So when, sorry, excuse me, when there was the stock dividend, when the stock dividend, okay, was distributed, or when it was declared, really. When the stock dividend was declared, the market value of the shares was $12 per share. Par was always 5. The difference was $7 per share, and that's the amount that gets credited to additional paid-in capital. Okay, now it also tells you that when the original shares were sold, this was what the original sale of the 700,000 shares. When those shares were originally sold, they were sold at $8 per share. That was the market value for the original sale. Okay, we know that the par value is always for this particular stock issue. Okay, it's $5. That doesn't change for stock dividend. So when the stock was originally sold, the difference between the market price and the par value was $3 per share. Okay, so these are two things that you have to calculate. Again, a little tricky. Okay, but let's walk through it. We're so smart, we can do this. Okay, now let's throw in an additional piece of information. The balance in the retained earnings account, okay, before the declaration of a stock dividend, okay, but after the addition of the current year's net income was $950,000. Okay, so the balance in the retained earnings account before the declaration of the stock dividend, remember the stock dividend is going to reduce the amount of retained earnings. Okay, so now it asks you, okay, bring this home, prepare the shareholder equity section of the balance sheet. Okay, again, you know this. Okay, remember, whenever you think of shareholders equity, that's the last section on the balance sheet, you know what has to appear always in the shareholder equity section. We only have common stock outstanding here. So you're going to have the common stock account, which is the first account which appears. Then you have the additional paid-in capital common stock, and then you know you're going to add the retained earnings. These are basically the three shareholder equity accounts that appear on the balance sheet. Okay, that's all we have to worry about. Now, first question, what amount gets capitalized to the common stock account? And this is at year end. Okay, at year end, how many shares of stock what is the dollar value that is going to be capitalized in the common stock account? Okay, so now if we go back to the problem, we see that originally this corporation had 700,000 shares of stock outstanding. Okay, well, let's figure out the number first. Okay, and Lysander, that's going to come into play, but in a little while. Okay, all right, and it gets tricky. Okay, so originally we know we had 700,000 shares outstanding. Okay, then what happened? The corporation issued a 10% stock dividend. Okay, 10% of what? 10% of the outstanding shares. So what I did here, okay, for what gets credited to that common stock account, remember, all the shareholder equity accounts have credit balances. The original, how many shares are outstanding at year end? We know we started the year with 700,000 shares of common stock, but we had a stock dividend. Okay, and remember, stock dividends are only for common shares. So what are we going to do? We're going to multiply those 700,000 shares by 1 times 10. Okay, because since we still have those 700,000 shares outstanding at year end. Okay, but now we have an additional 10% or 70,000 shares outstanding. Okay, so here, what amount is going to be credited though to the common stock account? Okay, okay, very good, Manpreet. We're going to have, but now we have 770,000 common shares outstanding. Which amount gets capitalized to the common stock account? Remember, anybody know, what is this par value here? Oh, sorry, what does this $5 here represent? The $5 or the par value. Okay, very, very good. So the 770,000 times the par value. Remember, that's always the amount that's going to be credited to the common stock account. It's always just going to be the par value. All right, so 770 shares, that's how many are outstanding at year end, times the par value always, okay, is going to equal the $3,850,000. Okay, so never get confused by that. You know it's always the par. Okay, now we have to consider the additional paid-in capital. This is a little tricky. Okay, because why? Because the corporation basically had 2 different events that affected the additional paid-in capital account. Okay, remember the amount that gets credited to the additional paid-in capital account is always the excess, okay, amount paid over par. All right, so remember here, what was the original amount that the stock was sold for? The original amount the stock was sold for was $8 per share. Okay, so the corporation's, the market value of the shares was originally $8 per share. Okay, but now we know that we already capitalized the par value. So the $8 per share minus par value, because that $5 per share was already credited to the common stock account. So it's that $3 difference, okay? The $3 times the $700,000, times the 700,000 shares of common stock, that's the amount that's going to be capitalized to the additional paid-in capital account. Okay, so it's this $3 times the 700,000 shares. And I'm going to show you the calculation in a moment again, just a summary. This is just so you get where it comes from. Lysander, sure. What's your question?
I know you said you was gonna do the calculation, but 3 times 700,000 equals 21.
Yes. Go ahead.
Yeah, it equals 2,100,000. So
right. So what? So and you're like, wait a minute, that doesn't equal that, right? So very good. Now, Lysander, you're on the hook. What else happened? There was another event that happened. What else happened? there was a stock dividend too, right?
Yeah.
Okay, so now what was the market price of the shares on the date of the stock dividend?
$8.
That was no, the $8 was when they originally sold it, but later on that same year, they decided to issue a 10% stock dividend. Okay, so what was the market value of these shares on the date of the stock dividend?
$12.
Exactly. Okay, remember, even a stock dividend is also going to be capitalized. It's also going to reduce the retained earnings. So what am I going to subtract from this $12 market share per share? What amount am I going to subtract from there to figure out the excess paid-in capital?
The par value.
Excellent. Always the par value. Very good. Go ahead.
$5.
Very good. Minus the $5, which is the par. And now this $7 difference, the $7, that's going to be capitalized also in the additional paid-in capital. But remember, what amount am I multiplying here? Only the $70,000. I mean, 70,000 shares, okay? Because remember, this relates to the stock dividend. So on the day here, only this additional paid-in capital only relates to the number of shares distributed through the stock dividend. Make sense?
Yeah.
Okay, I'm going to go over it again, okay? But just to outline it here, okay? So, okay, and now, and where's your picture, Lysander?
I keep trying to put it, but it keeps coming sideways. I don't know why.
That's okay. All right. All right. You have to do like an arrow. You don't have to. Don't worry about it now. I'm just teasing you. Okay.
All right.
All right. So Joshua. So the capitalized formula, original price per share times the amount of shares, yes, outstanding at that time. So at the time the shares were originally sold, this corporation sold 700,000 shares of common stock. Now, remember when they had this the stock dividend of 10%, they basically issued an additional 70,000 shares. And which is the amount that's capitalized on a small stock dividend? The market value of the shares. So the $12 $12 per share minus the par value, that's the amount that's going to be credited to the additional paid-in capital. Remember, this $5 here, the $5 times the 700,000 shares, and the $5, the par times the 70,000 shares from the stock dividend, that's already included here in the $3,580,000. So now, remember, don't get confused. Go back to your 101 information. Remember that the additional paid-in capital gets credited for the excess, okay, above the par value of the shares. Okay, so here let's just, here that equals the additional paid-in capital then, as it appears here, equals $2,590,000. Okay, how did I get there? Okay, let's just do it again. All right, so I know I had a stock dividend of 10%. Previously, the number of shares that were outstanding were 700,000. So when I had a stock dividend, I had 70,000 additional shares outstanding. Okay, I know the par value of those shares are $5. So that means the 770,000 times the $5 equals the $3,850,000. Okay, everybody good through this point? Okay, so only the par value gets capitalized in that common stock account. Okay, now though, which is the amount that goes to the additional paid-in capital? Okay, so got it. The only thing that really changes in the two formulas was, yes, the selling price per share, or the market, let's say market value, because yes, market value or selling price, yes. Okay, but now the additional paid-in capital. Okay, you're welcome. So originally, remember we had the 700,000 shares outstanding for the first part of the year? The additional paid-in capital that they received was credited which was credited to the additional paid-in capital account, was the market or selling price of $8 minus the $5 par. Okay, because that was included up here, the $5 par. Now, when the corporation issued an additional 70,000 shares with the stock dividend, since it was a small stock dividend, we had to capitalize the market value. Remember, the $5 par, okay, was already credited to the common stock account. So only the difference, the $12 minus the par value, it's going to be the 700,000 shares times the 70,000 shares times the $7. That equals this $490,000. Okay, so the 700,000 shares times the $3 equals the 2,100,000 shares. And that was your question, Lysander. Okay, so yes, first part of it is just the 700,000 times the 3, the excess over par. But since you had a stock dividend this year, you're going to take now, you have to add to that because the additional paid-in capital account was increased because of that stock dividend. So here you're going to take the 70,000 shares and multiply it by the difference on the date of the stock dividend, which is $7 per share. So that equals the $490,000. So what is the total amount that's credited to the additional paid-in capital? $2,590,000. Okay. Pretty good. It's just that in this instance, it's because of the fact that there was a stock dividend. It was a small stock dividend. So remember, the market value of these shares has to be added, not just the par value. If it were anything above $20 or 20%, that's when you wouldn't have to worry about additional paid-in capital. You just would have credited the common stock account. Okay, so remember, that's why that formula, immediately when you see stock dividend, you ask yourself, okay, is it a small stock dividend or a large stock dividend? Okay. All right, then the last question, the last account which we have to consider, okay, is the retained earnings account. So try to always stay focused. You know, in shareholder equity, you have a common stock account, you have the additional paid-in capital account. We figured out those balances. Okay, very good, Lysander. Now we have, now we just have a subtotal, the $6,440,000. Now though, okay, the question is asked, what is the amount that's going to be reported as retained earnings? Okay, so here we're just assuming, again, this problem is tricky. So this is worst case scenario. This problem is assuming that you know that this is the first year of operations. So there's no previous retained earnings that you have to deal with, okay, because you weren't given any. Okay, so here, we're told here, the balance in the retained earnings account before the declaration of the stock dividend. Okay, so the $995,000 was outstanding, 995 was outstanding before the stock dividend. Okay, but what do we know about a stock dividend? A stock dividend decreases the amount of retained earnings. Okay, so this was retained earnings before the declaration of the stock dividend, but after the addition of the current year's net income. Okay, so really what is it saying? It's saying this is the net income for the year, because it's really the first year of operations. What though is the balance in the retained earnings account? Okay, so here again, we're given $995,000. Oops, $995,000. Okay, but what else happened? Okay, in addition, we had the stock dividend. Okay, so that stock dividend decreased the amount of the retained earnings. How much did it decrease it by? It decreased it by the full market value of the stock dividend. So here we're going to take the number of shares that were issued in the stock dividend, which equals 70,000 shares. Okay, you're going to multiply it by the full par value, because it's a small stock dividend. The full market value gets capitalized or transferred to common stock and the additional paid-in capital of stock accounts. So what is the ending balance in my retained earnings account at the end of this year? $155,000. Okay, so this was complicated. This was a lot. Okay, the par value, no, the par value, remember, oh yes, I'm sorry, the par value, yes. And here we're only going to talk about stocks. We're not even going to discuss that second word yet. Okay, Joshua, here we're just talking about stock. Don't think about bonds yet. Okay, and remember, the par value is the face amount of each individual stock. Remember this, the par value or the stated value is always given for a particular issue. But remember, the par value is always the amount. Okay, remember, the other thing you have to remember about the par value of a stock, oh here, the par value of a stock is also the amount, okay, that gets credited to the common stock account. Okay, so remember here when we looked at our common stock account at year end, okay, we know how did that common stock, how did we come up with this balance in the common stock account? We multiplied the 700,000 shares that were originally sold at the beginning of the year, the 700,000 shares times the $5 par, okay? Then we added to that amount, we added the additional 70,000 shares from the 10% stock dividend. What amount did we multiply, Josh, that this additional 70,000 shares that were issued in the stock dividend? What amount did we multiply into the common stock account? How much did we increase the common stock account by for the 70,000 additional shares? When we issued, Josh or anybody, when we issued through the stock dividend, when we issued the stock dividend of 70,000 shares, what amount do we multiply by? Okay, 70,000 shares times what? Times the $5 par. Okay, that's the amount that gets credited to yes, the $5. That's the amount that gets credited to the additional paid to the common stock account. Okay, so that's another thing to remember about the par value. It's included in the description, but remember only the par value gets credited to the common stock account. If there's a difference, okay, when you sell additional shares for an amount, or if you have a small stock dividend, only the amount of the par value gets credited to the common stock account. Any excess gets credited to the additional paid-in capital. Okay, does that make sense? Okay, but in what cases were we multiplying? Okay, so when were we multiplying by the difference? Okay, that's when. Okay, so we're told here, we were told here again when the original 700,000 shares were issued at the beginning of the year, the market value of those shares was $5. The par value of those shares, I'm sorry, the market value was $8, and the par value of those shares was $5. Okay, so the X amount of the market value over the par, okay, times that 700,000 shares, that's the amount that gets credited to the additional paid-in capital account. Okay, so the excess of the market value over par, that's what gets credited to the additional paid-in capital. Okay, again, when they had a small stock dividend, when you have a small stock dividend, you always capitalize the market value also. Okay, the market value of the shares, and again, you're given this, the market value of the shares when you declared a stock dividend was $12 per share. Okay, remember, that's the amount that has to be capitalized when it's a small stock dividend. The par value of those shares was $5. That always remains the same. So this $12 minus the $5, that is the excess of the market value over par, the $7, times the $7 times the 70, times the 7,000 shares that were issued in the stock dividend, $7 per share, that's the excess, times the 70,000 shares that were issued at the time of the stock dividend. The excess is going to be credited to the additional paid-in capital. So the total amount of additional paid-in capital equals $2,590,000. Does that make sense now, guys? Remember, the additional paid-in capital is always the excess. Very good, Kristen. It's always the excess above the par value of those shares. Okay, that's why we have to calculate it this way. What goes into the common stock account? 700,000 shares times $5, and then plus the 7. So how do we get to this amount? How did we get the amount that was capitalized in this common account? Okay, we took the 700,000 shares that were originally outstanding. And Kristen, what did we multiply by? The original 700,000 shares to get to the common stock account, the credit to the common stock account. 700,000 shares times the par, excellent, times the $5. Very good. Okay, then, which equals the $3,500,000. Then, since we had a stock dividend, and that stock dividend was for an additional 70,000 shares of common stock, okay, what is the amount that gets credited to the additional paid-in capital because of the stock dividend? Again, only the $5, the $5 par. So if I add together 700,000 times $5, which is the par, remember this is the amount of the par. Okay, so the the $3,500,000 from the original stock sale. Then when I have a stock dividend of 70,000 shares, that additional $350,000 for the par value gets credited to the common stock account. And then any excess above that $5 par, that's the amount that's going to be credited to the additional paid-in capital. Okay? Does that make sense now, guys? Okay. Okay, $1 million question. Okay? If it was a large stock dividend, okay? If I told you this was a large stock dividend, okay, what would be, so we started out with, in the additional paid-in capital account, we started out with a balance of, hold on, I'm sorry. In the additional paid-in capital account, we started out with a balance of the seven, don't look, don't get confused. We started out with 700,000 shares times what? Times $3, right? 700,000 shares times $3. So we started out with a balance after the original sale in the additional paid-in capital account. After the original sale, we started out with a balance of $2,100,000 in the additional paid capital account. Okay? $1 million question. If I told you that this stock dividend was a large stock dividend, okay, would it have affected the balance in the additional paid-in capital account? If it was a small stock, I'm sorry, if it was a large stock dividend. If it was a large stock dividend, would the additional paid-in capital account be different? Okay, what amount do we capitalize when, what amount gets capitalized when a large stock dividend? Par value, excellent. So if it was a large stock dividend, don't forget that. You have to apply that rule. If it's a large stock dividend, which amount gets capitalized? Only the par value. Okay, so that means would the balance in the additional paid-in capital account be affected? You rethink your answer. No, exactly. Very good. Okay, very good, guys. No, you would only credit the common stock account because you're only going to increase When there's a large stock dividend, you only increase that common stock account, not the additional paid-in capital account. Okay, does that bring it home for everybody? That's good? Okay, very good, guys. Okay, so that's a good way to bring it home. Again, what do you mean capital? Another way when it's another way to say you reduce the retained earnings and basically transfer the balance of retained earnings to the common stock or the additional paid-in capital. It's said that you're capitalizing the retained earning. Okay, you're turning it into a capital account or one of the shareholder equity accounts. Okay, so if Joshua, if I ask you that on an exam, what does the term capitalized mean for your retained earnings? Like when you have a stock dividend, a stock dividend, what happens to the retained earnings? The retained earnings gets capitalized or reduced. Very good. And you reduce retained earnings, but you're also increasing at the same time, you're increasing the capital accounts, the common stock accounts. Okay. All right, everybody's good? Review these problems, remember, on your own. It will be excellent for a studying tool. Okay. All right, so let's move on. We still have a little more. And this is now exercise 12.5. Okay, guys, stick with me. I promise you, the more you put into class, the less studying you'll have to do. All right, and remember, the great thing about this chapter, yes, there's a lot of information. But if you look here, all the information has to be provided to you. You just have to know, how do I apply the information? Okay. Excuse me. Okay, so now we're computing earnings per share. Remember, earnings per share, the basic formula is net income, okay, divided by the number of common shares outstanding. Remember, net income does not get applied to, remember that preferred shares outstanding does not apply or participate in earnings per share. Earnings per share, again, is just a ratio, okay? It's just an analysis tool. Doesn't mean there's actually a distribution in any way, but it's used for analysis of the financial statements by creditors or shareholders of the organization, okay? All right, so now let's start with the problem. The net income of Foster Corporation amounted to $1,920,000. So that's the starting point. You know that's always going to be in the numerator if it's an earnings per share problem. Okay, so here, compute the amount of earnings per share under these different scenarios. All right, so first a scenario is there were 400,000 shares of $1 par stock. There was no preferred stock outstanding. Best case scenario, in this instance, we just have the net income figure. We don't have to worry about preferred earnings per share. We don't have to worry about preferred stock or any dividends that relate to the preferred stock. Okay, the number of shares outstanding has not changed. Okay, so all we do, we take the net income figure, 1,900,000. This is simple earnings per share. Okay, we're going to divide by the number of common shares outstanding over the year, which is 400,000 shares. You have to be told that. So what is the simple earnings per share going to be? $4.80 per share. Okay, that's pretty simple. That's the basic formula. Okay, now let's look at B. Okay, so for B, the question is, now in this scenario, we have 100,000 shares of common stock outstanding, but we also have $100 par preferred stock. And here, you really should be told this, okay, in this problem, but we're just going to assume it here. this preferred stock is cumulative preferred stock. Okay, it's not non-cumulative. Cumulative. If we're going to include it in our calculations, it has to be cumulative preferred stock. Okay, so here, again, in our second analysis, we're going to start with the net income figure. That's always in the numerator, 1,900,000. Now, though, remember, if there is cumulative preferred stock, which is outstanding, the amount, even if the dividend has not been declared, okay, the amount of that cumulative preferred stock dividend must be subtracted from the net income. Okay, and again, this is just for analysis purposes, because remember, if it's cumulative, if it's a cumulative stock dividend, the amount that the preferred shareholder due must always be paid out of the retained earnings. Okay, the cumulative preferred shareholders are due this particular amount of the dividend, even if it's not paid for this year. Okay, so what we're going to do, again, it's an as-if scenario. We're going to take those 100,000 shares of cumulative preferred stock, okay, multiplied by the dividend rate of 8%. Okay, but remember, the answer is not $8,000. Remember that when you have any type of preferred stock, you always have to also multiply by the par value of those shares. So a dividend is always going to be based on the number of shares times the dividend rate times the par value. If it's a dividend rate, you must multiply it by the par value. So basically, the preferred stock dividends on the cumulative preferred stock, okay, equal 800,000 shares, $800,000. That $800,000 must be subtracted from the net income. Okay, then you're going to divide here by the number of common shares outstanding. Here we're told it was 300,000 shares. Okay, so again, you know, it's not 100,000. We changed it. Now it's 300,000 shares you're dividing by. So what is the earnings per share of common stock? All right, under the second scenario, $3.73. Okay, so this is a good problem to review your knowledge. Okay, question. Okay, what if I told you this was non-cumulative preferred stock? Okay, if this was non-cumulative preferred stock, would this $800,000 dividend still have to be deducted? No, very good. Remember, non-cumulative preferred stock, excellent everybody, you would not deduct the amount of the dividend, because if it's not declared this year, it's lost. Okay, it's the fact that it's cumulative preferred shares, that's why it has to be deducted. Okay. Let me see if there's anything other question I could come up with. Net income, preferred shares. Oh, very good. What happens if? Okay, this is a good question. What happens if it's cumulative preferred stock, but this dividend has not been declared? It's still outstanding for 3 years. This corporation has not paid a dividend for 3 years. What amount? Okay, what amount would be deducted here when I'm calculating earnings per share if dividends have not been declared on this preferred stock for 3 years? Okay, it's cumulative. Okay, how much would be deducted? Would it be the 800,000, or would I? Okay, Francisco, you think 2,000,004? Anybody else? Any other daring souls? Everybody thinks, okay, Mark, you think $800,000? Okay, Mark is right in this instance, but I don't see his picture. Okay, if it doesn't matter, okay, and this was a little tricky part, Francisco. Here, even if the dividends have not, and they're cumulative preferred dividends, if they have not been paid for 3 years, 2 years, whatever it is, only the current year's dividends are going to be subtracted, okay? Because only these $800,000 worth of dividends apply to this year's net income, Okay, so even if you were told as a distraction, okay, that's okay, you're welcome. So even if you're told, you probably will be told, well, the dividends haven't been paid for 2 years, again, on the preferred cumulative stock, you could, the dividends for those earlier years were subtracted from the earnings for those years when you were calculating earnings per share. So here, it's only going to be, it would always stay $800,000. Okay, unless again it was non-cumulative. All right, so a little tricky there. Okay. All right. Again, use this for practice. It's a great idea. All right. Now B. Okay, and question B is a great question. Okay, and I want everybody to pay close attention. Okay, here, if I ask, is the earnings per share figure that is that's being calculated here, is that considered basic earnings per share or diluted earnings per share? Okay, is this earnings per share figure, if I ask you, is that basic or is it diluted? Okay, remember, very good, Lysander, it's basic. Good, Denise, Kristen, okay? It is basic earnings per share. The only time, okay, everybody, 2 points I'm giving to you. The only time you do diluted earnings per share is when you have convertible securities, okay? This is just not, there's no convertible securities in these calculations here. It's just the fact that preferred, cumulative preferred stock is outstanding. So that's why we had to do this calculation, okay? This is not a diluted earnings per share. This is still considered basic earnings per share, okay? Because we didn't take into account any convertible securities. We weren't told about that. Okay, so although the company here has common stock and preferred stock both outstanding, when we had the preferred stock, that computation did not affect, was not a convertible security. So it's just simple or basic earnings per share. And that's a good point. Okay, so if I ask you, when is the only time that diluted earnings per share comes up? Only when you have convertible securities. Okay, and remember, is the earnings per share, is it required to be reported on the annual financial statements? Is earnings per share a ratio or a piece of information that must be? Yes, very good, Joshua. It's required. Okay, it's required by GAAP for it to be reported. Very good, Dante. And you're going to have, remember, if you have a disposed of segment of business, you're always going to show earnings per share for the continuing net income and also for the net income, that last net income. And most likely it'll be supplied for the discontinued operations as well. Okay, so just that in mind, a little bit of a recap. Okay, everybody's good here? I think we have one more problem that we have time for. And then next class, we'll start with chapter 10. So please, by Thursday, make sure it's not a long chapter, but it's a lot of information. That's going to be the quiz chapter, okay, that I'll announce after we finish the chapter. I'll announce the date of the quiz, and that's the extra credit, okay? The score on the quiz that you get, it's a half-hour quiz online. Whatever score you get on that quiz, up to 10 points is then added to your midterm grade. Okay, and the quiz will be on McGraw-Hill Connect. All right, and it is optional, but I don't know why anybody would not take it. All right, but you have to be present in that half hour. There are no makeups for the quiz. All right, so we're on our last question. Again, great problem for dividends, earnings per share, etc. You really get to see the difference here when you have a stock dividend or a stock split. Okay, remember what Apple just did was a stock split. Okay, when you have a stock split, let's do a little bit of a review. Okay, so Nahid, before I answer your question, answer my question. Okay. Nahid, first of all, I don't see a picture, so I'm going to have to pick on you. If you have a stock split, is there a journal entry for a stock split? Yes or no? He's like, I wish I didn't. No, no. Remember that if you have a stock split, there is never a dividend. Okay, it's just a description change and a change in the notes. Very good, guys. Kareem, Stellan, Lamai, Dante, Casey, very good. And Jeffrey. So Nahid, there's never a journal entry, so you're very happy when you have a stock split. No journal entry required. And just here, Nahid, is the quiz on Connect? Yes, it will be on McGraw Hill Connect. Okay. All right, so let's do the problem. Last problem. So Cosmere Company has, you're welcome. Cosmere Company has 50,000 shares of $50 par value common stock that was originally sold for $60 per share. Okay, so then again, just to recap what we went over before, what amount when we originally sold these shares, which was the amount that was credited to the additional paid-in capital, you would take the 500,000 shares that are issued, and then you would multiply by the $10 difference, okay, because that's the difference between the par value and the market value. It was originally sold for $60 per share. So what is the amount that gets credited to the additional paid-in capital account? $5 million. The difference between the par and the market price. Okay. And where does the 5 million shares times the $50 par value get credited to? It gets credited to the common stock account. Okay. So just to go over a little review from earlier. Okay. Oh, also for those of you who asked so far, if you want to do a review just of chapters 1 through 11, I posted the PowerPoints where we have our normal PowerPoints on Blackboard. I posted them there. And then I'll be posting 6 to 11 later today. Okay, so you can do a review. Okay, but you have to really remember 101 to do 102. I'm sure you're recognizing that now. Okay. All right, so during the most recent years, the company carried out the following activities. They declared and distributed a 10% stock dividend. Okay, then after that, they declared and paid a cash dividend. Okay, remember, if I'm talking about a 10% stock dividend, what type of dividend is this? If there's a 10% stock dividend, you know that is only on the common shares. Okay, so the common shares, exactly, excellent. And what comes to mind immediately, good. Look how smart you guys are. Shamil, Lamai, and Dante, you're thinking immediately, boom, small stock dividend. Excellent. Okay, so you had a small stock dividend of 10%, then you paid a cash dividend of $1 per share. The thing to remember here is you have to track the number of shares outstanding. Okay, it makes a big difference. All right, and then after the cash dividend, this company is doing really well. Then after that, they had a stock split. Then after the stock split, they paid a $60 per share cash dividend. Okay, please remember that you have to track the number of shares outstanding. Okay, it's really important. And it's not hard, it's just you have to remember that as the shares change, any subsequent action after the change is affected by the new number of shares outstanding. Okay, so here, determine the number out of shares of common stock, okay, that are outstanding after the 4 transactions described. Okay, so you started out with 500,000 shares, okay? After, the first thing that happened was a 10% stock dividend. So you took the 500,000 shares outstanding times 1.10. Okay. So what is the new number of shares that are outstanding? The 550,000 shares. So you start, if you want to do it differently, you started out with 500,000 shares outstanding originally. If you took the 500,000 times 10%, that equals 50,000 shares. So the new amount of shares that you have outstanding equals 550,000 shares. But that's only after the first transaction. Okay, that's only after this a 10% stock dividend. Okay. All right. You also had a cash dividend. Did the cash dividend affect the number of shares outstanding? Did the cash dividend? No. Excellent, guys. Very good. You're getting it. Very good. Okay. However, when you had the 2-for-1 stock split, did that affect the number of shares outstanding? Yes. Very good. So all you're doing here is tracking. This is sometimes the confusing part. Remember, though, when you're tracking the number of shares outstanding after a stock split, remember, before the stock split, you now had 550,000 shares, not the original 500,000, because you had a stock dividend before that. So what's the number of shares that are outstanding after the stock split? 1,100,000 shares. Okay, so once after the stock split, you had 1,100,000 shares because you doubled the number of shares that are outstanding. Okay, and here, please remember, cash dividends. When we had a cash dividend of $1 per share and 60 cents per share, the two cash dividends, they do not affect the number of common shares outstanding. Okay, so let's go to letter B. Letter B, determine the total amount of cash that the company paid in the 4 transactions. So now this is the tricky part, okay? Because we have to track the information. All right, so originally the first thing that happened was they declared a stock dividend. The first thing that happened was they declared a stock dividend. So here we had a stock dividend, remember the 500,000 shares times 1.10. So after the stock dividend, we had 550,000 shares outstanding. The next thing that happened was they paid a cash dividend of $1 per share. That cash dividend of $1, okay, is basically multiplied by the 550,000 shares because the number of shares outstanding has been revised. So the new number of shares is 550,000. The next event that happens is the cash dividend of $1 per share. So the amount that was paid out by that cash dividend equaled $550,000. Okay, so here we're talking about cash only, but we still have to look at the number of shares that are outstanding. Okay, so what else basically was paid out? Okay, what was the amount of cash? The second cash payment was a 60 cents per share dividend. Okay, but what happened to the number of shares outstanding before that dividend? Again, we know we had 550,000 shares outstanding previously. Okay, then what happened was 550,000 shares, but remember we also had a stock split. All right, so the amount of the amount of common shares that were issued a stock dividend, the last stock dividend of 60 cents, is 1,100,000 shares, which was the 550,000 shares that were outstanding after the stock dividend. Then we had a stock split, so we 2-for-1 stock split. Okay, so the number of shares that are outstanding increased to 1,100,000 shares. Okay, after the stock split. So we take that 1,100,000 shares, multiply it by the 60% stock dividend, and that gives us a total cash dividend that was paid of $660,000. That's the second cash dividend. So what was the total amount of cash paid for dividends this year? $1,210,000. Okay, so again, you have to track the sequence of events. Started out with 500,000 shares outstanding. We had a 10% stock dividend. The number of shares outstanding increased to 550,000. Then they declared a cash dividend of $1. So 550,000 shares times the $1 equals $550,000 cash dividend paid, the first one. Then we had a stock split. So it was the 550,000 shares outstanding. So that's really important to track, dollar amounts versus common shares. we had 550 common shares outstanding. Then we had the 2-for-1 stock split. And there were 1,100,000 shares outstanding. 1,100,000 shares times the 60 cents equals $660,000. Okay. Remember also that no cash is paid out with a stock dividend or a stock split. Okay. Again, is there a journal entry for a stock split? The answer is no. It's just a description change. Very good. Okay. Only a stock dividend requires a dividend. Requires a journal entry. Okay. Now, great question. Okay. If you were a shareholder who basically held 100 shares of the stock that you purchased 4 years ago, okay, when the market value of the shares was $65. So you can see this is a calculation that you would really want to do. Okay, so here, this is a calculation that you would really want to do. All right, so you bought 100 shares and you bought it for $65 per share. So that's the amount that you originally paid. Okay, the 100 shares times the $65. The original amount of your investment was $6,500. Okay. Now, what is the market value of those shares after the 4 transactions? Okay, because you see here, how many shares would you own after the 4 transactions described? Okay, so now, don't get nervous. You know that you originally purchased 4 years ago. You purchased 100 shares. Okay, then the corporation declared a 10% stock dividend. So after the stock dividend, you owned how many shares? After the stock dividend, how many shares did you own if you bought 100 shares? 110. Excellent, guys. Very good. Okay. Then what happens when the corporation had a stock split, a 2-for-1 stock split? How many shares of common stock were outstanding after the split? Very good. 220 shares. 220 shares. You own 220 shares after the stock dividend and the stock split. So I'm just tracing these above events. Okay, then what happened? And the market value of those shares is $6,500. Okay, but that's how much you originally paid. Okay, now you're told here that the market value of the shares after the 4 transactions is $40. Okay, and maybe before you really read this chapter, you would be like, oh no, the market value of the shares that I owned, it fell from when I first purchased it at $65, it now fell to $40 per share. You might be upset, oh, you know what, I lost money in this transaction, but in effect, you didn't. Okay, what happens now? Remember, you actually are the owner because of the cash dividend, because of the stock dividend and the stock split. You're now the proud owner of 220 shares. So you take the 220 current shares that you own, multiply it by the current market value, which is $40 per share. What is the value of your investment today? $8,800. Okay, so what happens? You actually, just in terms of the, and again, you're not being taxed on this. This is just the market price for the shares. Based on the market price of the shares, you have basically earned, okay, or you basically, the market value of your investment has increased by $2,300. Okay, so your investment has increased on paper. This is a paper gain of $2,300. Not bad for 4 years, right? Based on a small investment that you made. Also, but don't forget, you didn't just, this is basically what the market value of your investment, the difference in the market value if you sold the shares today. Remember that in addition, okay, why else does an individual buy shares of stock? For cash dividends. Okay, remember that basically you also received a dividend of 10% of your original shares that you owned, the 100 shares that you owned, plus you also earned a cash dividend on the 110 shares that you owned after the stock dividend. So how much cash have you received? Okay? From the 100 shares originally owned times the 10%, you receive the original on the $1 cash dividend, you received $110. On the second cash dividend, which was 60 cents per share, but then on the revised number of shares that you owned, 110 shares, how much cash did you receive in terms of cash dividend? $242. Okay, so what has the increase in your cash position if you sold your shares today? Okay, what would the overall increase in your cash position be? It would be $2,542. Okay, and again, that's the reason that people buy stock, for an increase in the market value, which you see here, and also for dividends that may be received. Okay. Any questions? Oh, I went over a little over. Okay. So please review the homework for this chapter. Make sure this is all very familiar with you. Please also read chapter 10. It's an abbreviated chapter. It's a short chapter, only certain pages. But we're going to have a quiz on it. It's a complicated chapter. Okay. Yes. And the recording, usually I post the recordings as soon as the class is finished. Lysander. Okay. All right. Very good. You're welcome, guys. Thank you for attending. Keep up, the good work. Okay. Shamia, Gerson, Kareem, Joshua. All right. And we will start with chapter 10 on Thursday. Okay. And the slides for chapter 10 will be they're posted now in this recording, but I'll post them again. Where do you post them? Okay, so what you have to do, Lysander, is when you first click on the Blackboard Collaborate, what you have to do, there's a tab at the top. You don't go into the sessions, the upcoming sessions, on the bottom of the page. There's a little tab on top. When you click on it, it will show you recorded sessions or just sessions. You click on the recorded sessions. Oh, see, it's this little tab right here. You see it in the upper left-hand corner. Go to that page and you'll see it then. Tab on the upper top left.
Yeah, I see it. I see it.
Okay, very good. You can go there. Okay. Oh, you're welcome. Okay, thank you, Daniel. Everybody, remember, it's there for your review. Thank you, Harmeet. Thank you, Maria. How are you? Have a good day also, and I'll see all of you. Maria, I know what you look like. You might as well put your picture. Okay, Daniel Lee also, okay? You're welcome, Francisco. See, here's a picture. Everybody, please, picture just helps. Good, Daniel. Oh, all right. Okay, good. Thank you. All right, everybody, have a good day. And stay healthy. That's the most important thing.